Hey Snapchat, I'm here in Palo Alto. I'm going to be teaching 2 courses at Stanford Business School tomorrow, but today you're going to get an advanced lesson because you follow me on Snapchat. One of the topics I'm going to cover tomorrow is how do people value startup companies? To do that, I first want to give you a really basic understanding of how people value public stock companies in the first place. The most common method we were all taught in business school of how you value mature companies is called DCF. DCF stands for discounted cash flows. So you basically add up all your future expected cash flow and discount it based on some sort of interest rate. That's because the value that a company creates is the cash it generates in profit in the future, known as cash flow. What we were always taught for mature companies is you value 5 years of discounted cash flow, and then you assign something called a terminal value in year 6. The terminal value in year 6 has to account for all of the future cash flows that you expect in the future based again on some sort of discount rate. In a mature company, it's usually very easy to predict the first 5 years cash flow, and the 6th year, because it's a linear growth, is also easier to predict. The key word I've chosen in all of this is growth, because if you have super high growth rate, it's harder to predict, and much more of the value is the terminal value. So DCFs are how companies are valued. In an M&A transaction, it's also how the acquiring company values the company they want to buy. And if they pay more than the DCFs that they can calculate, it's based on synergy, saying, well, we think if we buy them, we can get more cash flow. So even though public equity analysts do look at DCFs, there are some shorthand ways of valuing companies. The most commonly known shorthand is P to E. You've probably heard this before, price to earning. So obviously, if a company's priced at $20 a share and has $5 per share of profit, its P to E is 4. Faster growing companies end up with much higher P to E ratios than slower growth companies. The second shorthand you sometimes hear is price to sales ratio. I'm going to explain why. In the early days of a company, even a public company, sometimes they're not yet making profits, like SaaS. That's when you do price to sales. Price to sales is a little bit more of a blunt instrument than price to earnings because it doesn't tell you much about the quality of the sales. But for example, in recent bull markets, the price to sales ratio of SaaS companies got above 12, then it dropped down to 7. If you're not a fast-growing SaaS company, some of the price to sales ratios can be in the 3 to 5 range, so growth matters. That's why the third thing that people shorthand sometimes is price to earnings growth. People shorthand this to PEG, which is price to earnings growth, which again is just a shorthand for fast-growing companies are worth more. The final thing, not worth going into too much detail, that you may occasionally hear is price to enterprise value, which includes debt and some other things into the calculation. So the reason for me to explain to you how public companies are valued is that, believe it or not, private valuations are a function of this. Because growth rounds are done before a company goes public, they pay the most attention to what the multiples are. You can't pay a price to sales ratio of 20 in a growth round when you know it's going to get 7 in a public round. If you decide to pay a higher rate than the public market rate, it's because you believe that company's going to grow faster. B rounds are slightly less scientific, but they do know that they have to have the C round or growth rounds prices, so it does get closer. So now let me explain to you why seed and A round investments are actually correlated and in areas where they're not. Over time, A round investors develop an intangible sense of how the B rounds tend to get priced for deal types. If I know that B rounds are typically getting done at 30 or 40 pre in, let's say, enterprise software, I know I need to pay much less than that in order to drive. So I do get acutely aware of some of the metrics on what people are paying for ARR, annual recurring revenue, or MRR, monthly recurring revenue. It's just a little bit less sophisticated. So there's a little bit of a trick to how people ultimately price A rounds. In part, A round investors want to own a certain percentage of your company. The usual minimum target is 20%. So often an investor who's willing to give you $5 million for an early stage company would price it between 15 to 20 pre, because that gets them between 20 to 25% of your company. They're only going to do that if they believe B rounds based on your growth projections are going to get them to 40 to 50 pre in the next round. If they don't believe that your company should be valued at 15 to 20 because they don't believe that you're going to grow, they might just offer you less money to lower price. So they might offer you $3 million, say, at a 9 pre to a 12 pre. In good markets, people tend to pay up at earlier stage because they know people are going to pay up at later stage. I'd love to say it's scientific, often it's not, but just know that the downstream rounds are based on some rational public value. And seed investors over time, professional seed investors, get finely tuned into what people are willing to pay in an A round. So in kind of 07, 08, 09, where people were paying 3, 4, 5 pre for seed rounds, it eventually creeped up to 6, 7, 8, 9 pre. And in some cases, they were paying 10, 12 pre. And why that adjusts so quickly is if the A round investors start dropping price, but I'm a seed investor pricing at 10 pre, I'm going to end up getting a down round. So that's how it works. People are just a function of the valuation that's going to be paid in the downstream round behind that. They definitely tie it to metrics because people develop a fine-tuned sense of what people will pay based on performance. The closer it is to a public market filing, the closer it is to real public market comps and valuation.